in its totality, pulses form a very small segment. You have corn, you have wheat, and you have oilseeds like soybean, which are much, much larger commodities. So I want to share with you my view about the direction which this market is likely to take over the rest of 2012. And my sense is that the pulses market will probably follow this direction. But I'm going to set a direction. And I'm going to, over the next 15 minutes, take you through some of these expectations of mine. I'm also going to raise a lot of questions. There are questions to be thought through. The first one is in the last 2 years, that is the whole of 2010 and 2011, we had a series of weather events which affected supplies, as a result of which actually prices increased. Farmers, particularly in the industrial economies and developed economies, Canada, the US, and Australia, and several other countries, have actually got now a decent amount of cash reserves. And fertilizer prices, simply because of a fairly moderate increase in crude prices, fertilizer prices have remained quite affordable for the farmers. And therefore, my expectation is that over the next 6 to 8 months or so, farmers are going to use a lot more input than they used in 2010 and 11. Therefore, the question simply is, will there be supply response to high prices in 2010 and 11 during 2012? This is the question all of us have to think about. And the next question is, because weather was not friendly in 2010 and 2011, will it turn benign in 2012? And we'll, of course, find answers to these questions too. The next one is the external environment. All of us know the second half of 2010 and the first half of 2011, and even the second half of 2011, the external economic environment has not been robust at all. In fact, it is rather weak. Those of us who've been following OECD global indicators, composite leading indicators for the world, have seen a very significant slowdown in each one of the major economies of this world. And because of economic slowdown in the last quarter of last year, that is 2011 last quarter, October, November, December, we found a sharp decline in the prices of major agriculture commodities, be it sugar, be it soybean, be it wheat, or corn. Simply because a lot of speculative capital went out of the market and there was a huge sell-off, huge profit taking. As they say, cash was king. And even now, cash is king. People don't want to invest in commodities in general and agriculture commodities in particular. So the question again is, will this external environment improve? Will there be a judicious resolution to the European sovereign debt crisis? There are apprehensions about China. Is China slowing down? I track Chinese trade data very closely month on month. There are indications that Chinese trade data suggest that there is a small slowdown. Will the slowdown continue? Will it pick up or will it worsen? We still don't know. That's the next question. We then come to inflation concerns and monetary policy and the role of speculative capital. We found the whole of 2010 and 2011, the central governments of major economies, particularly emerging economies, China and India, for instance, tightening credit regularly. I think both China and India tightened credit about 15 times in about a 20-month period, very simply because they in fact decided to compromise growth and wanted to control inflation. So inflation control became their priority, and therefore they tightened credit. The question now is, what's going to happen in 2012? Is there a possibility of easing of credit? Will they de-squeeze this credit? Is a big question. China and India also, the central banks of these two countries have now given some very incipient signals that they are willing to reverse the direction, and this credit squeeze will now start to ease. And that will have an implication for money supply and for demand. And importantly, the yuan over 2011 has actually firmed up by 4% vis-a-vis the US dollar, which simply means imports into China are going to become less expensive. That's actually a major demand factor. And the other factor is speculative capital. We found in 2010 and 2011 a huge amount of speculative capital flowing into commodity markets in general, gold and silver, of course, crude oil, base metals, and to a lesser extent in agriculture commodities. But a large part of the speculative capital in major agriculture commodities actually exited in the last quarter of 2011. So the question is, will they come back? And why should they come back? And under what conditions will speculative capital come back? I think these are questions which have to engage us. And the last one is crude oil dynamics. The very positive relationship between crude oil prices, the positive relationship between crude oil prices and agriculture commodity market prices is absolutely well established simply because crude oil is a universal intermediate. It increases the cost of synthetic fertilizers, it increases the cost of mechanized production of agriculture commodities, increases the transportation costs. Therefore, high crude oil prices automatically translate to high agriculture commodity prices. Where is the crude oil market headed in 2012? The signals are, of course, very, very clear to all of us in the last several weeks. Those of you who've been tracking crude oil market, the signals are very clear. Will there be further deterioration in the global geopolitical uncertainties, or will it ease, or will it slow down? We still don't know. Therefore, there are questions and questions and questions to be thought over. And let's try over the next probably 7 or 8 minutes to try and find some answers to these questions. My sense, very simply, is that in 2012, suppliers of producers of agriculture commodities, particularly in industrialized economies, would begin to invest more in crops. They would use more fertilizers, more pesticides, better seeds, etc. And therefore, in my opinion, 2012 is going to find a significant supply response to major agriculture commodities. Take wheat, take corn, take soybean, take sugarcane or sugar, cotton. I think 2012 is a year when production, in my view, global production of these major agriculture commodities is going to rebound. Therefore, the second question is weather, which is a major uncertainty, as all of us know, and no one has any control over weather developments. We've had 2 bad years, 2010 and 2011. And this was primarily both El Nino and followed by La Nina. The probability of a third bad year seems to be rather low. And this La Nina, which is even currently affecting South America, Brazil and Argentina, is already beginning to weaken. And therefore, there is reason to believe that the negative impact of a La Nina will be much less than what we apprehended earlier. Therefore, there is hope that the world will return to normal weather. And this is my central assumption, that the world in 2012 will return to normal weather, and that will have a significant impact on acreage and on crop yields, particularly in the context of our expectation that farmers will use increased amounts of inputs for their production. Again, my expectation, first half of 2012, the situation for agriculture commodities will be relatively tight. It will be relatively tight simply because production in the northern hemisphere is actually going to happen in the second half of the year. We are now in the first half of 2012. And therefore, in the first half of 2012, we will still continue to feel the spill-off negative effects of 2011. And therefore, I'm expecting global agriculture markets to continue to remain in a relatively tight situation in the first half of 2012. And for reasons that we saw earlier, that there will be a supply response to prices, in the second half of this year, I'm expecting a major rebound in agriculture commodities, major crops, grains and oilseeds to rebound. And therefore, there will be a substantial easing of availability of major agriculture commodities in the second half of 2012. Weather vagaries, yes, all of us know about weather vagaries, but weather always played a crucial role in influencing the agriculture markets. But as I said earlier, the risks relating to weather are abating. The possibility of a return to El Nino condition, which usually follow La Nina, can of course affect production in the months ahead. But the probability, I'm told by experts, weather experts, that is much less. The next point I want to make is there will be stock build. At current prices, even in this tight, fairly tight situation in the first half, which will begin to ease as we go towards the second half, there will be stock build by processors and traders simply because they need to service the market for the months ahead. Therefore, the stocks which will be built over the next 3 or 4 months will actually help moderate a price rise, even in the event a El Nino condition happens and it starts to affect prices and production. Speculative capital. My expectation is that after the experience of the last quarter of 2011, when cash became king and speculative capital actually exited the market, it's going to take quite some time for the hedge funds and other funds to actually enter agriculture commodities. In the last 3 months, hedge funds exited the market, there was profit taking, etc., simply because of the weak global economic outlook. And there is much less risk appetite amongst speculators currently. This is likely to continue over the next several months, in my opinion. For that's the hedge funds, are more likely to stay off the market, particularly agriculture commodity markets, simply because of the expectation that there will be a rebound in production. And also a firm dollar, which all of us are expecting vis-a-vis the euro, is certainly going to help commodity prices stay moderately friendly to consumers. Crude oil outlook is something which concerns me quite deeply. The crude oil market is absolutely constructive. In my opinion, the demand and supply fundamentals for the crude oil market are absolutely tight. Non-OPEC supplies are most unlikely to grow or expand to meet growing demand for crude oil, and therefore there'll be a call on OPEC supplies. And when there is a call on OPEC supplies, I think there is a huge possibility that prices will certainly stay buoyant. And geopolitical instabilities are certainly going to impact crude oil supplies and crude oil prices. Therefore, if there is a directional change in crude oil prices, I expect that directional change to be on the upside rather than on the downside. So there is a risk to crude oil prices, and that risk can potentially translate to a price risk on the upside for agriculture commodities. And the agriculture markets will have to bear this cost burden. So in sum, I am expecting in the first half of 2012 reasonably firm prices. And these firm prices will begin to ease as we move towards the second half, simply because of an expectation of a rebound in major agriculture commodity crop production in the second half of the year. And subject to normal weather, we can expect supplies to rebound and prices to certainly ease lower, and inventories to start rebuilding amongst processors. The upside risks, as I said, are weather aberrations and crude prices. But wait a minute. We've looked at the supply side all these in the last 15 minutes. There is something called the demand side. And now, with the latest OECD composite leading indicators, which came out yesterday, probably day before, I think there is hope. It very clearly demonstrates that the global economy is showing signs of a positive change in momentum. The US macroeconomic data have been positive in the last 3 or 4 months. Data for Russia are positive in the last several months. The entire OECD economy as a whole is showing very positive change in momentum. Even positive change in momentum as far as India is concerned, particularly from the industrial production perspective. These are OECD's leading indicators, composite leading indicators. And if these leading indicators continue to run their course over the next 3 or 4 months, and if the global economy begins to buoy again, maybe slowly, but the direction is if it's clear that it's going to buoy, and we have sustained flow of positive macroeconomic data, I expect a significant increase in demand. Therefore, on the one hand, we have strong possibility or a high probability of a supply rebound in agriculture commodities in 2012. And if we have sustained flow of positive macroeconomic data over the next 4 to 5 months, then in the second half, one can also expect a strong or a reasonably good buoyancy in demand. And if we have good supply response and a good buoyancy in demand, it's more likely that agriculture markets, rather than being in a state of surplus, will actually be in a state of a tight balance. And when any agriculture market, it's axiomatic in a commodity market that when a market is in a state of tight balance, the funds will start to come in. The funds will start to come in and look for opportunities of investment either on the short side or on the long side. And therefore, if we are going to get into a tightly balanced market fundamentals of demand and supply for major agriculture commodities, particularly in the second half of the year, I think the probability of an upside risk to prices does exist. But if the market's going to stay in a clear surplus, all major agriculture commodities, including pulses, then of course the funds will stay off, they will not come. But in the event global economic growth signals turn positive, demand also rises, and the balance becomes tight, I expect then funds to start flowing into this market, and then it can buoy prices up. So this is the direction which I am looking for as far as global agriculture markets are concerned. And if there is a risk to prices to the upside, it will come with an increase in demand. If there is a risk to prices downside, it will come with extremely good supply.